Good morning, everybody, and welcome to Equites Property Fund's interim results for the 6-month period ending in 31st August 2021. Obviously, very disappointed not to be with you all again. We hope by year end that a degree of normality will have come back, and hopefully we can have a cup of coffee and a biscuit and chat through the results too. So today's results will start with a little bit of an intro from me, our strategy, just to reiterate where we're at, a little bit of market intel in terms of the UK, South Africa, and then what we've done this year. Rian will follow up with the operational highlights and major issues that have been conquered and are playing out in our portfolio. Then Layla will touch on the financials, both from a numbers point of view, but also from a treasury point of view. And she'll give us a bit of insight in terms of the ESG elements of our business, which are becoming stronger and stronger. We have the pleasure of having our UK partners online as well, and on Zoom they will be presenting all the exciting things that are happening in the UK in our joint venture. And then following that, a little bit of a resume from me, an outlook and prospects, just to wrap it up, and then we'll have a bit of Q&A at the end of it all. So that's today's proceedings. So let's start, and let's start with our strategy. Our strategy is to remain a globally relevant REIT focused on the logistics sector. I think this has been our strategy now for at least the last 4 or 5 years. We've presented this slide in every single one of our presentations, and we continue to present it because we continue to live by it day by day. So I think it's very important that we're there. I think the consequences of that is shown that these interim results are a reflection of the defensive nature of our portfolio, of the quality of the product that we own, the quality of the covenants that occupy our product, and the relationships that we're building with these potential clients, and how we've built this business from the humble of 1 billion rand on listing in 2014 to in excess of 21 billion today, something that we're obviously extremely proud of. In terms of our business strategy, I mean, in terms of what we're doing, so within South Africa, obviously, our primary focus is to develop best-in-class warehousing for clients. Now, as we've reiterated on many occasions, a lot of older warehousing in South Africa is potentially technically obsolete, and what we're seeing in the UK, across the globe actually, is that the demand drivers are for bigger facilities, and as a consequence of the bigger facilities, higher volumes of vehicular movement, which means massive yards and the like. So the opportunities are coming, and we'll talk to those in a bit more detail. So we predominantly look for pre-let business, and you'll see in our pipeline in terms of the pre-let business that we have done and what we are about to do. We also continue to look to acquire assets that meet our very strict investment criteria, and then we also are very favourable to sale and leasebacks and entering into joint ventures with major retailers where the opportunities arise. In the UK, very much the same. We have secured through optionalities predominantly various tracts of land which we are looking to unlock with the skill of the Newlands team, and we'll talk to some of those unlocks and how they're progressing in a very favourable way later on in the presentation. We from an Equites point of view, in terms of the assets that we want to keep in the UK, we'll only execute on a pre-let basis. However, there will be opportunities for us to do turnkey developments in the UK, and also to do speculative developments on our land for third parties, in which we are secured a price and make a profit, and we move on. And again, we will talk to that in a bit more detail coming up. So let's just go to, I suppose, what today's all about. And the most important part, obviously, are the metrics that we are looking to unlock. The first one, obviously, the distribution at 5.3% growth period on period, which is very much in line with the guidance. And I think we're very comforted by the fact that we are very much in line with all the uncertainty that's been around in the marketplace in the last 18 months, for us to continue to deliver in terms of our guidance and be able to achieve what we're achieving. I mean, I must commend my team incredibly for that. In terms of NAV, we see the NAV growth. This number would potentially have been significantly better if it hadn't been for a bit of exchange rate strength from the rand, which not necessarily a bad thing, but the reality is that from period to period, the rand has played against us in terms of our UK portfolio on that. Following the capital raise and the DRIP, our loan to value is sitting at 28.6%. Obviously, our whale, which is something we're very proud of and I think is unbeatable within the South African context anyway, at 14.7 years is fantastic. And with the addition of the Amazon and the Hermes facilities at year end, the likelihood is that number will probably grow as well. As I said earlier, very pleased that our portfolio has also grown. And the growth, though, I must reiterate, it's not growth for the sake of growth, it's growth with quality. And that's what is essential. In that, we've also disposed of assets. We disposed of the 2 Stoke assets at the back end of last year, and we continually are looking at opportunities to dispose of assets that have become non-core. We believe every asset in our portfolio is a great asset, but doesn't necessarily meet the criteria that we currently require of our portfolio. So let's move on to what have we done in this first half. So let's start with, we've concluded obviously a fantastic acquisition of the Attack portfolio. We'll go a little bit into detail there on a 50% undivided share on 3 fantastic assets, which we're very pleased to bring into our portfolio. We've concluded a turnkey development on the Hoyland's Plot 2 land, and our Newlands team will talk in more detail on that, which has resulted or will result in Equites sort of making approximately £6 million of profit, which will go straight to the bottom line, won't be distributed. We've completed the Sandvik development up on the R21, which obviously was the last of the developments that came in from pre-COVID, and we'll talk to some of the developments which are starting at the moment in a moment. In terms of our debt facility, we issued a note at JIBAR plus 165 on a 3-year basis, and that was placed with a single client, and obviously the pricing that we achieved was extremely pleasing to us as an organisation. It really reflects the appetite that there is for our debt. In that, obviously, we were very pleased, obviously, with the capital raise in the period as well, which also showed the appetite for our paper in the equity markets. In terms of sustainability, and this is the first time we report on this, very pleased that our solar output has gone from about 89 megawatt hours in the last period to 978 megawatt hours. So you can see the implementation of this ESG strategy starting to come through, and we would like to think that this number will only go from strength to strength. Probably won't grow at the same percentage base because obviously we started from a zero base, but notwithstanding that, we will invariably see growth of that as more and more buildings come online, and we go through our sustainability audits on our existing portfolio too. In terms of the balance sheet, obviously we raised 1.3 billion, 300 through the DRIP and 1 billion on the accelerated book build, and obviously very pleased with that too. This obviously is us sort of being extremely proud of our organisations, and we're really wanting to outline our performance relative to our peers, and it has been very humbling to have had an organisation, and we've come out of a recent spate of board meetings obviously to approve these numbers, where we spoke about where we were a year ago, and the trauma of the experience of everything that we went through, and not really knowing where our business was. And we'd spoken a lot to the defensive nature of our portfolio, and that it would be able to withstand some shocks, and we certainly were thrown a big shock last year, and I think we not only withstood it, but I think we've come back from it with flying colours, and I think this graph really highlights that. Over and above that, we're pleased that our free float has also increased as a consequence of that. We've become a bigger percentage of the various indexes on the JSE, and as you can see on the last index sort of recalibration down the 17th of September, the quantum of shares that traded in our stock was substantial. I mean, it was an all-time record, 265 million rand in one day, which is unbelievable. And what we are noticing is that the liquidity of our paper is basically improving month on month and certainly year on year. So let's talk about the logistics sector, and let's start with the UK. And I suppose, you know, when we entered in the UK in 2016, you know, we always thought that the UK was a good market and that there would be legs and there would be headroom for us to achieve certain goals. The reality is the UK market has astounded, I think, even the most optimistic person that has lived this. And our UK partners who have been in this industry for a long time, I think will testify to that in a bit. And what we can say is that, I mean, some numbers have just come out with the Q3 numbers having come out with another 15.7 million square foot of take-up in the UK. That takes the total for the year to 46.9. And just to put things in context, last year was the record year with 51.6 million square foot of take-up, and we've still got a quarter to go. The reality is we'll smash through last year's record. Over and above that, we've seen land prices go pretty aggressively on the back of just demand drivers, and the demand drivers are fueled by a lack of supply. The lack of supply and a bit of construction inflation is also driving a process of rental growth, which will obviously benefit the existing base portfolio, but also is giving us great opportunity. Over and above that, what we're seeing is yield compression come through the market, and that yield compression really is seen by the quantum of transactional activity, with the first 3 quarters of this year, basically £10.8 billion of transactions have already happened. 10.2 was last year for the whole of 2020, wasn't the record year. 2017 was the record year with 11 billion, and I think we'll smash through the 11 billion number, but we won't smash it as crazily as we might expect. And I think the reason for that is I think there is a supply side issue, that there is just not enough stock to buy. I think that will continue to drive pricing. So what is feeding this take-up? What is feeding this demand? Personally, I think these things are being fed by, let's start with the disruption of supply chains. And these are a consequence of what's going on in China. China was the production facility of the world, with energy problems, with the political instability that's potentially coming through, and with the marked sort of antagonism between the world and China. We're seeing more and more businesses potentially looking to remove their manufacturing capacity from there. A lot of the consequence of that is you're going to see onshoring, but over and above that, you're also going to see massive increase in inventory levels compared to the just-in-time that was there historically. Events like the Suez Canal blockage for 10 days, events like Brexit, and the events like the heavy goods vehicle driver, lack of them in the UK. I mean, I believe this morning's paper in the UK said that of the 5,000 visas that they've allowed for foreign drivers, they've only had 27 applications. So it's interesting times. The consequence of that, though, is that the inventory levels have to get bigger. What we're seeing that is that obviously warehousing is becoming bigger. Over and above that, what you're seeing is that more and more retailers are going to what they define as Omni-Channel Distribution. And what that means is holding inventory at warehouse level rather than in store. And even if you're selling through store, though, the inventory only gets moved at the very last minute, because the last mile delivery and the delivery platforms have improved so dramatically in the last 5 years. I mean, I had a conversation with one of the directors at Cushman's in the last week, where he's indicated that there isn't a single 300,000 square meter plus warehouse in the UK that is not under offer at the moment. I mean, these are just unbelievable stats that defy any sort of semblance of reality, if you like. And that is reflected in this slide where we talk, and I think we've shown the yield compression that's coming through across across the market. And I mean, let's talk to a couple of recent transactions. I mean, there was a multi-let industrial park in London that transacted at 2.6% yield. Now, why did it transact at 2.6% yield? The buyer believes that he's going to be able to negotiate in the next 2 years increased rentals that will take him back to between 3.5% and 4%. So that's driving rental growth, and there is a belief that rental growth will be dramatic in the UK in the years to come, which all bodes very well for the portfolio that we currently own. You'll have seen in the last couple of days the Segro-Schroeder swap, with Segro wanting the last mile platform in London, and Schroeder's happy to take 2 quality assets in the Midlands. You know, 2.5% yield, I believe, in London, and 3.6% in the Midlands. So, I mean, yields for quality assets in the Midlands with a 3 in front of them are becoming standard practice in the UK. Let's talk to the UK, to the SA market, sorry. So the SA market, you know, I don't think e-commerce is driving decision making in terms of real estate, but as you can see from the graph on the right-hand side of this, that the online sales as a percentage of total sales of the various retailers is definitely growing. We don't foresee that slowing down. We foresee that to continue to grow. Obviously, Takealot is keeping everybody on their toes as well on the side as well, and they continue to grow market share. And what we're seeing is a continuous supply chain optimization. And as I said earlier, the omni-channel word is becoming sort of the buzzword, if you like, in the space. And what you can see is the amount of the major retailers are really investing in their supply chain. And you can see this by historic deals that have been done and been built, such as the PEP facility up at Hammersdale, in excess of 100,000 square meters. DSV have built a 145,000 square meter facility on the R21 here in Johannesburg, and a 55,000 square meter facility in Cape Town. I mean, Pick n Pay are building a 140,000 square meter facility on the R21. Massmart have built 3 substantial facilities, I believe, up in Riversands in Joburg, 70,000 square meters. Cape Town and Durban are both sort of 50,000 square meter plus. So the quantum of deal flow is definitely there. The competitive nature of the market obviously has led to all the very high quality developers in the marketplace to get a piece of the cake in different markets. And there are several significant RFPs that are coming through the system at the moment, which are all sort of 40,000 square meter plus RFPs as well, in Cape Town, in Johannesburg predominantly, and some also for the Natal region. So in a nutshell, we are also fairly optimistic in terms of what's happening in South Africa, and I think our pipeline talks to that. And if we look at what we're doing on the development front, you can see that we obviously completed the Sandvik development earlier in the year, but we've signed up an extension on the TFG building up at Lord's View, and that will go to 40,000 square meters on completion. We've done a deal with Cargo Compass, which is a freight forwarding business, which is going from strength to strength, and that's going into our new security estate at Jet Park, less than sort of 2.5 kilometers from the airport and right on the highway. So we're very, very excited about that addition to our opportunities, and really we continue to want to build best in class, and that means the highest sustainability issues, but also commensurate yard space, commensurate heights, commensurate floor flatnesses, commensurate suitability for a modern logistics facility for businesses to be able to go for the next 10, 20 years of their businesses sort of unscathed. On that, I'm just going to wrap up now quickly on the attack portfolio, which basically became unconditional a few days ago after Competition Commission approval, and that will start going through its transfer process. Obviously, we are well versed in transactions with the attack team, and a great team that we've worked really well with over the years. We already own 9 properties in the Waterfall precinct, and the addition of 50% of these 3 properties that are coming on, 2 already built and income producing from day one, and the third one, a development deal which we will be assisting the attack team in fulfilling, which should be complete in May next year as a 20,000 square meter plus facility for Cotton On in the facility. So on that note, I think I've done what I needed to say. And I'm going to hand over to Rian, and he's going to take you through the property fundamentals.
Thank you very much, Andrea. Andrea alluded to it, but the essence of our business is the development and ownership of modern logistics facilities, improving logistics nodes, led to A-grade blue chip tenants on long-dated triple net leases. And it's these property fundamentals that translate into the numbers that we ultimately achieve. We've, over the past 7 years, continuously sought to improve our property fundamentals, and we've done that through the diligent application of our very stringent investment criteria, and this is what causes our sustainable, predictable, and growing income streams. Now, when you look at the fundamentals as they stood at 31 August 2021, you will see that we've increased our property portfolio size to just over 21 billion. And I looked at the number at August 2020, and it was 16.2 billion, which means that we've grown our portfolio over the past 12 months by more than 30%. And we've done that by increasing our WALE, which was 10 years at the end of August 2020 to 14.7 years at the end of the current period. And we've also increased our exposure to A-grade tenants from 95% to 97%. You will see that our vacancy levels are really insignificant, and our in-contract escalations of 6.8% gives us the continuous growth in our income streams. The split between our UK and SA exposure has been interesting over the last couple of years. You will note that at the end of February, the split was 66-34 SA UK, and our exposure to the UK has increased over the past 6 months, and it's now 38% of our total assets. You would have noted from the result that was released this morning that we've got a UK pipeline over the next 3 to 5 years of in excess of £800 million. We've also got, over the next 12 months, opportunities in SA and the UK of 4.2 billion, of which 2 billion rand is already contracted, which means that over the next 2 to 3 years, our exposure to the UK market would probably reach about 50%. And after that, the sheer weight of opportunities through our land holdings in the UK will probably take our exposure to the UK over 50%. You'd also see that we've got a good exposure to land. Our development capability is ultimately what creates outperformance, and it's extremely important for us in both South Africa and the UK to have land available in key logistics areas so that we can participate in RFPs and also take some of our existing tenants to service their expansion requirements. Looking at the lease expiry profile of our portfolio, we've continuously focused to enhance the sustainability and longevity of our income streams. And you can see that currently about 66% of our income in terms of our leaseholds, lease terms are expiring beyond 5 years. We've only got 8% of our lease income expiring within the next 2 years, which means that we've got all the time to sit down with our tenants and look at their requirements, seeing whether the current facilities meet their requirement, and also through our sustainability and other initiatives, looking to enhance these facilities for them. 97% of our income, as I mentioned earlier, is now coming from A-grade tenants, and I think the nature of our business is that we've only got 64 properties, 54 of them in SA, so we're not in a situation where there is hundreds of properties in property retail centres which makes management of them very difficult. So we're in the fortunate position where we can really spend the time on these properties to make sure that we derive maximum benefit from them. The next slide refers to the period that Andrea referred to earlier. I mean, COVID about a year and a half ago, 27 March, the first lockdown started, and we remember making our first calls to tenants, and we didn't really know what to expect. As we previously reported, we approached the situation with our tenants with a very open mind, and we granted significant rental deferrals to them, and we've worked with them over the past 12 to 18 months to help them through this very difficult period. You will see that our SA collections stands at 99.6%, and in the UK we collected 100% of our rentals. We've given additional relief to 2 tenants during the first half of 2022 in an amount of 1.5 million rand, which in the bigger scheme of things is insignificant. And in long-term relief that still needs to be recovered in SA is about 6 million rand. We've not had any defaults on these deferrals, so we're very pleased that we've been able to come out of this very difficult period unscathed. The riots in July was also big news in South Africa. We were fortunate in that only one of our properties were affected, and we had damage of under 1 million rand. We have already put in a team of contractors to the property, and we are hoping that the property will be fully remediated by the end of the month. The tenant was fortunately able to continue operating from the facility, and all the costs that we're incurring will be recovered under the Sasria policies. This slide refers to our innovation and our property management, and there are 3 things that we are doing. Firstly, we've partnered with a company called Equites that has received significant support from the IMF, and we are conducting sustainability audits on every one of our 54 properties in South Africa, with a view to improving our sustainability elements on these properties. We've received the results back from the audits in respect of most of the properties, and the feedback from our tenants has been very, very positive. Many of our multinational tenants have got funds available to further improve the properties, and we're looking to really make a huge impact for them, because ultimately, the greener the building, the less the operational cost for these tenants, and there certainly is a big focus from our teams to also improve the ESG capacity and capabilities of our company. We've also implemented assisted maintenance programs with our tenants. Through cost cutting and difficult economic climate, many of our tenants doesn't have big maintenance teams anymore, and we've provided that service to them. And we've also received very, very positive feedback from our tenant questionnaires. We've got a happy tenant base, and we're looking to create further business from them, because as Andrea has always said, the cheapest and best business you'll ever do is the repeat business. That in short is a summary of our fundamentals, which we're really very proud of and continue to be the cornerstone of our business. Thank you, Andrea.
I think I'm going to hand over to Leila now, and I think she's going to take you through the numbers.
Yeah, thank you very much. Thanks, Andrea and Rian. I guess to start, let's look at the financial highlights once again. Andrea alluded to the 5.3% growth in distribution per share, and just to echo the sentiments of Rian, where we really do focus on stable, predictable rental income, and that's why the 5.3% is a very strong 5.3% growth, underpinned by very strong like-for-like rental growths, which we'll touch on a little bit later when we work through the distribution statement. The NAV per share, a growth of 2.2%, supported predominantly by fair value uplifts in the UK portfolio, and slightly pulled down by the strong exchange rate at period end, but nonetheless a strong growth in net asset value per share. Our loan to value is 28.6% at 31 August, and again, it's just representative of a very conservative approach to our balance sheet management. Our weighted average debt maturity is 3 years, and in our efforts to renegotiate with banks, we've really focused on extending the tenure, but also on securing the best pricing on these facilities. And then at 31 August, we had 1.6 billion rand of cash and available facilities, which we will use to really implement our pipeline in the second half and beyond. If we move on to the distribution statement, which really is a breakdown of how we achieved our growth in the distribution per share, I think the first line to look at is the property-related income, and this was largely driven through strong like-for-like rental growth in the underlying South African portfolio. That amounted to 7.5% compared to the prior comparable period. This was also further supported by new developments which came online, including Altron Diagnostics, Imperial, and the UK developments. Admin costs, there's a notable increase in the admin costs as an absolute value, but if you look at our admin cost ratio in line with the growth in our property portfolio, this is actually fairly consistent. It's actually come down from the prior year, but it is worth noting that as our business is growing and expanding in the UK, there has been an increase in these expansion costs associated with the UK operation, as well as an increase in headcount. If we look at the non-controlling interest, the obvious increase is that Shoprite came online and it was in for the full period this year, which resulted in a notable increase attributable to the non-controlling interest. And then just if we look at the antecedent dividend and the number of shares in issue, that's as a result of the accelerated book build, which was well subscribed in July, and the dividend reinvestment program relating to our May dividend. We love these bridges, and I think it paints a nice picture of what contributed to the growth, but really just echoing a lot of what has been said already in the distribution statement. I think the first line to point out that 4.7% is driven by like-for-like rental growth, and again, that's the cornerstone of our portfolio. We constantly want to see rental growth from the underlying portfolio strong, and we're confident that the contribution to distribution per share is fairly robust for this period. The Shoprite acquisition contributed 1%. This Shoprite acquisition was funded largely through debt, and as a result, it was accretive in this period. The developments contributed 1.3% in this period due to the fact that they came online in an accretive manner, but also the fact that there was no cessation of capitalization for this period under review. And then if we look at the detractors, the ZAR was a lot stronger in this period than it was in the prior comparable period, and this detracted 1.1% from the DPS growth. The LTV ratio, the cost of decreasing the LTV is obviously the associated cash drag and the fact that we had to invest some of those proceeds in investments which weren't particularly accretive, shall we say, but we understand fully that this is the cost of maintaining a robust balance sheet. And when Andrea talks about the pipeline, it's evident as to why we had to maintain a very low LTV. And then lastly, Rian touched on the additional rental relief which we provided, and that detracted 0.3% from our DPS growth. And that's really the build-up of how we arrived at the 5.3%. If we move on to the financial position, I'm just going to highlight a couple of line items. The fair value of investment property, Rian's already spoken about the movement in investment property, and this was largely as a result of developments which were completed during the period, but also significant fair value movements on the UK portfolio. And I think we're very confident that the growth in investment portfolio is supported by strong fundamentals. There's a line item, trading properties, which was highlighted by a number of analysts and investors at the last reporting date. That number has increased, and that's as a result of land parcels in the UK which are marked for sale. You'd recall that we released the SENS a month ago, which refers to the sale of land at Hoyland's Plot 2. And this includes the Basingstoke land as well as Hoyland's Plot 2 and one further parcel of land, which are all going to be incorporated in transactions which are available for sale. Then the held for sale properties, that's also increased from the prior period, and the increase largely relates to 6 properties which are earmarked as part of a Statement 102 disposal. And then if we just look at the equity attributable to shareholders, again, the increase is predominantly related to the accelerated book build as well as the dividend reinvestment program. If we look at the NAV bridge and we just look at how we move from 1725 to 1763, the 53 cents relates to the uplifts on Hermes and Amazon. Those are the 2 developments which are obviously underway at the moment, and we recognize some fair value uplift on a percentage of completion method. We haven't taken all the uplift now. The majority of it will be recognized on completion, but just in line with our policy, we were mandated to take a percentage at this reporting date. Then our core UK portfolio increased by 5.1% on a like-for-like basis. Andrea has spoken to the trends in the UK logistics market, and you can see that this is supportive of that compression. If you look at our results, we speak a little bit more in detail just about the actual compression on our portfolio. There was about a 30 bp compression from Feb to August. And I think this is just in line with what we're seeing in the UK logistics market. Then, unfortunately, there was a 27 cents decline as a result of the ZAR strength. We went from 21.03 at Feb to 1997 at August, so that was about a 5% ZAR appreciation, and that reflects in a dilution in the net asset value. And then 8 cents as a result of the capital which we raised in the accelerated book build. This was obviously raised at a premium to our net asset value. Then there's 26 cents dilution or reduction in the NAV, and that's as a result of recognizing deferred tax assets relating to the fair value movements in the UK. In the prior period, we spoke about the reason for recognizing these deferred tax assets, as we are now subject to corporation income tax rules. This is not a cash flow, this is an accounting recognition or an accounting adjustments which we have to recognize. So you will see that this is recognized on the balance sheet and on the income statement, but not for the purposes of distribution. And all of those movements result in the NAV of 1763 at 31 August. If we just move on to the loan to value bridge, again, a couple of movements. This one's fairly simple to explain, but if you look at, we started at 31.2, we raised capital both through the accelerated book build and the DRIP, and that was a 6.4% reduction to the loan to value. And then we spent about 1.2 billion rand between South Africa and the UK, which then increased the loan to value. The fact that there was some ZAR strength further increased the loan to value. And then the UK valuation uplifts reduced that loan to value by 0.8%, which takes us to the final loan to value of 28.6%, which is incredibly conservative, but we definitely have plans to spend the money in the second half of the year. If we touch on property valuations, we like to explain our property valuations and to split them out by different property types. Just a couple of elements which we'd like to draw your attention to. 100% of the UK portfolio was externally valued at this reporting date. Given where yields have compressed to, we felt that it was prudent to recognize or to have all of these externally valued. So they were split between two different valuation firms, and 100% of them were externally valued at this reporting date. That resulted in the 5.1% increase in the like-for-like property portfolio in pound terms. Then we valued 74% of the South African portfolio externally, and this South African portfolio valuations were relatively flat over the period. Again, if you look at the average values per square meter, they're fairly consistent with the prior reporting period in South Africa, but in the UK we've seen a slight increase in the rand or in the pound per square meter. I think if we just move on to Treasury Management, I think we've touched on the loan to value, but again, just to reiterate, the loan to value has come down fairly significantly from 31.2% at Feb to 28.6% at August. If we look at our debt maturity, it's 3 years. And just to give you some color, over the last 6 months, we focused on renegotiating our South African debt facilities. We've renegotiated 2 of these, both to incorporate sustainability elements. And in the second 6 months of the year, we'll focus on renegotiating the UK facilities. If we then look at our all-in cost of debt, in line with where global yields are, global interest rates are, our all-in cost of debt has continued to decrease. However, we are of the opinion that the interest rates will probably be subject to some increases next year or in the next couple of years, and that's why we've adopted a fairly stringent hedging policy, which I'll touch on in the next couple of slides. We have 1.6 billion in undrawn facilities, again, as previously mentioned, and this is really to support our strong pipeline, which we'll implement in the next 6 to 12 months. If we just touch on our approach to debt funding, we've really focused on diversifying our sources of debt funding, and as you can see in the graph, we now bank with most of the major banks in South Africa, with 2 major banks in the UK, and we also have a very well-established debt capital markets program. We listed a 300 million rand note earlier in this year at a very keen price, so we listed at JIBAR plus 165, which is definitely market leading. We also had an upgrade from GCR, which upgraded us a notch, and we're now rated as AA-. I think what's important is just to note that all of our renegotiations at the moment are incorporating sustainability elements, which does help from a pricing perspective, but more importantly, it's not the sole reason as to why we're doing it. We want to ensure the sustainability of our entire portfolio, and incorporating those elements helps us to be innovative in the way that we're renewing our debt facilities. If we just touch on our interest rate hedging, as we discussed, we do believe that we are at a fairly low place in the interest rate cycle, and therefore we have hedged 98.8% of our term loans and 81.6% of our term loans plus capital commitments. The CCIRS, we always get a lot of questions about these. As we have previously discussed, as we grow our UK portfolio, we will look to fund more of our UK portfolio in country, and this is evident in the rate of CCIRS utilisation. So this has come down from 25.2 at Feb to 23.2 at August. And again, as we grow our UK portfolio, we're constantly evaluating new ways to utilise in-country pound funding to fund our expansion. Just on a foreign exchange, from a foreign exchange risk perspective, we adopt a progressive hedging policy, and the policy is well documented. I think most investors and analysts understand it quite well. We have made sure that we have hedged in line with our Treasury policy, and we've hedged 80% of our income for the next 6 months, which means that that's fairly predictable at the levels which are illustrated on the table. Okay, so I'm just going to move on to ESG, which dovetails quite nicely from finance, but at the same time, I do want to make the point that this is much more than just an effort which we look at from a finance perspective. ESG has really become ingrained in our very DNA. We look at it holistically, so we wanted to just touch on 3 elements. For the E, our objective is really to contribute to improvements from an environmental and sustainability point of view. So what have we done in the last 6 months? All our new developments are either EDGE certified or BREEAM certified in the UK. We've conducted sustainability audits across our portfolio to ensure that all our existing developments can be brought up to scratch, and if there are improvements which can be done, we are engaging with tenants to see how that may be done effectively. We've engaged in a carbon emission baseline exercise which will help us to fully understand our carbon footprint as well as to set our net zero goal. And then, as Andrea alluded to, we're almost at the 1 gigawatt per hour mark in our portfolio, and we'll look to improve this going forward. From a social perspective, our objective is really to promote the development of our communities and our people. What have we done? Diversity has always been front of mind in all of our employment decisions. We support our staff in terms of further education and tertiary studies where possible. We've also supported social upliftment projects through partnerships with non-profit organisations through our foundation, the Michelle and Frankie Foundation. And then from a governance point of view, we want to make sure that governance is front of mind, because we understand that we need to adopt best-in-class governance practices if we want to ensure sustained value creation for all stakeholders. What have we done? We've revised all of our board charters. We've also made sure that all of our committees are functioning optimally. We've appointed, as most of you would have seen on SENS yesterday, we've appointed 2 new independent non-executive directors, which means that the composition of our board is far more favourable in terms of best practice. And then lastly, we formed an internal audit department which will function specifically to identify how we may improve our internal control processes. So I think that pretty much sums up E, S and G. I'm going to hand back over to Andrea now.
Fantastic. Thank you, Leila. We're going to hand over now to our colleagues in the UK. Simon Williams will start the presentation where he'll take us through some of the exciting things that are happening. And then Graham will talk to the pipeline, which is the future. So over to you guys. Simon.
Thank you, Andrea, and good morning to everybody in South Africa. First slide relates to Equites Park in Hoyland. The site at Hoyland totals 80 acres and is located at junction 36 of the M1 motorway in South Yorkshire. The pre-let to Hermes totals 31,500 square metres and sits on a development plot of 54 acres. Construction of the unit remains on programme, on budget, and is scheduled for practical completion in February of 2022, early part of next year. And all of the early access criteria that Hermes have set us has all been successfully met. At practical completion, Hermes will enter into a 20-year FRI lease with fixed uplifts throughout the term at the 5-yearly rent reviews. The facility is Hermes' largest facility in the UK, and once operational, will process over 1 million parcels per day. The development received strong support, both politically and from the local planning authority, principally due to the 800 to 1,000 jobs that will be created once the facility is fully operational. Just moving on to the second slide, which is the Amazon development at Peterborough. The 17-acre site forms part of the well-established Peterborough Gateway development and is located on the A1M, approximately 50 miles north of the London M25 motorway. The last mile delivery facility totals 13,200 square metres and reached PC recently on the 15th of September. Amazon have now entered into a 15-year lease with fixed uplifts throughout the term at the 5-yearly rent reviews. Amazon are now well progressed with rolling out this design of last mile logistics facility across a number of locations throughout the UK. And as a result, they are becoming an established asset class within the investor market. We also understand that a number of the parcel delivery operators in the UK, such as Hermes and DPD, are looking to incorporate a number of the actual design elements within the Amazon logistics buildings for their own future developments. Moving on to the next slide, which relates to the second plot up at Hoyland. As part of the Hermes developments I just mentioned, we're also constructing all of the site infrastructure and services to serve plot 2, which is the remaining 26 acres of the wider Hoyland site. We've recently transacted on a development of 2 speculative units for Arrow Capital Management, totaling 41,500 square metres. The development is on a freehold turnkey basis with initial land sale, which provides profits at day one to fund the construction. There is then a balancing payment at PC. The required planning applications have now been submitted and are expected to be determined towards the back end of this year. This will then enable a site sale in Q1 of next year, with practical completion of both buildings towards the end of Q3 next year. And then moving on to Basingstoke Gateway. The site is located at junction 7 of the M3 motorway, 25 miles west of the M25. The site in total is 68 acres, and in April of this year we received planning permission for a 2.4 million square foot on 42 acres of the site for a market-leading online retailer. That facility is identified as plot 1 on the master plan. Some specific tenant enhancements and alterations with the scheme have subsequently been required, and as a result, the application goes back to committee on Wednesday, the 27th of October, and this application has been recommended for approval. This application will incorporate all the site infrastructure and services to serve the total 68 acres. And a further planning application for a pre-let to a single occupier will be submitted in early 2022. This application will cover the remaining 26 acres of the scheme. I'll just hand over to my colleague Graham, who's going to chat through the future pipeline.
Thank you, Simon. Morning, everybody. So I'm just going to talk a little bit about the rest of the UK portfolio that we've been working on for a number of years. It's perhaps important before I sort of run through some of the specific schemes, just to sort of touch on the market, which Andrea sort of highlighted earlier, but it's important just to really emphasise that the UK continues to be constrained by supply, and that isn't just the supply of buildings and investment stock that's available to buy, but importantly, it's a supply of land in the UK that has a planning permission. And that's primarily down to the planning system in the UK being quite protracted. Not everybody has the skill set to unlock opportunities. They might have the capital, but you need the skill set in the team to unlock opportunities. So we've been working really hard as a team over the last sort of 2 to 3 years to sort of build a portfolio to feed the machine. And Simon's highlighted some of the schemes that we're on site with, or in Basingstoke, hopefully about to be on site with shortly. But there's a whole portfolio sort of sits behind this that the team have been working incredibly hard over the last 2 to 3 years. And we're now starting to get really close to a number of planning applications being submitted. So there's a lot of work that goes in behind that in terms of working with the local planning authority, unlocking problems, consulting with local sort of interested parties and the general public. So we're super excited by the portfolio that the team's been working on over the last few years, and hopefully over the next couple of years we can really start to bring these forward. And there's a lot of occupier interest in these sites already. Andrea touched earlier on the sort of level of demand in the UK, and we're seeing record interest in our schemes. We've started to put a lot of information on our portfolio on our website, and that's attracted a lot of interest. So a lot of schemes that we haven't actually got planning on yet and we're about to submit for planning, we're already getting a significant amount of occupier interest, which is really exciting. So if we just chat through a number of those opportunities that we're working on, hopefully you can see the slide with a map of the UK in front of you. So the first one I'll talk about is at Rugby. That's a 23,000 square metre scheme. We already have an outline planning permission in place for this development. This is located on the M6, junction 1 of the M6, so it's a great location. It's next to an existing established logistics park, and we're working up a detailed application for a specific building. We have 2 occupiers interested in the scheme at the moment, so we're now pushing ahead with a detailed application which we hope to submit in the last quarter of this year, and that would enable us to be on site in 2022. The next scheme to touch on is at Nottingham Junction 24 of the M1, pretty close to Seagrove's East Midlands Gateway scheme. Another great location, very close to East Midlands Airport, which is the second largest freight hub in the UK after Heathrow. We received outline planning on that scheme probably in the last month, and we're already in legals with a third-party funder who wants to develop 4 units speculatively. So we're about to submit what we call a reserve matters application for those 4 buildings in the last quarter of this year. That'll be for 75,000 square metres, which we will then hopefully be on site with next year, and that would deliver a profit to Equites in excess of £10 million. The next scheme to talk about is at Newport Pagnell, which is Milton Keynes. It's number 4 on the map if you look at the UK map on the right there. Great location, this sort of sits midway between London and Birmingham, so it has the ability to serve both the Midlands markets but also the South East. Sits immediately adjacent to the M1 motorway, the main motorway that runs north-south from London to the north. We're in for planning with an outline application of about 80,000 square metres, hoping to have planning permission in Q1 of next year and be on site next year. We have a lot of occupier interest in that site already. We could probably let that twice over as we sit here today, so we'll continue to work that through planning and talk to occupiers through next year. Then at Thrapston is a site that sits on the A14. The A14 is the main east-west link between the ports on the east coast and the Midlands and Birmingham. So we've got a site there that the team have been working hard on and taking that through the planning process. We've done a lot of sort of public consultation and working with officers and members, and we're now very close to submitting an application of about 200,000 square metres. So we're looking to submit that in November. So next month that should be into planning and hopefully go through planning in Q1, Q2 next year. And this is another site where we have a lot of occupier interest, and again, we could probably let that sort of twice over as well. We're getting significant interest in that site. So those are sort of key sites that we're either in for planning or very close to submitting planning. There's a number of other sites in the portfolio there that you can see that the team are working hard to sort of prep for submission of planning, and that has the ability to deliver in excess of 1.5 million square metres of floor space. We'll talk in a bit on the next slide about the next 12 months, but just in terms of the next 24 months, very broad brush, the team are very focused on concluding the deals at Hoyland, Barnsley that Simon talked about. The spec deal at Junction 24 is another key deal that we want to get over the line. Basingstoke, which Simon touched on, we hope to announce the occupier in the last quarter of this year. And then Newport Pagnell, which I've just touched on as well, we also hope to announce shortly. Through looking beyond that, in 2023, we would then hope to be on site at Thrapston, Peterborough and Cambridge. They'll all sort of come in behind those schemes in 2023. But then there are other schemes as well that the team continue to work on. So with the supply and demand dynamics of the UK and the slow planning process that we have, we're constantly looking at feeding the machine. So it's very exciting. We've got these sites coming through the portfolio at the moment, but we continue to look at other opportunities where we see value and opportunity so that we can continue feeding the machine sort of beyond 2023. So perhaps if we then go to the next slide. So this is just looking ahead specifically over the next sort of 12 months and what we anticipate through 2022 sort of doing and achieving. So really just finish off the sort of last quarter of this year. Simon mentioned earlier that we're going to committee at the end of this month on Basingstoke with a recommendation for approval. We're also looking then at drawing down the land on Junction 24 for the speculative deal that we talked about earlier. Potentially going to committee at the back end of this year on Newport Pagnell, but also making the second payment on Newport Pagnell. I think just touching and pausing on Newport Pagnell specifically with that second payment, we sort of acquired that site off market, and Andrea touched earlier on land values and rental growth in the UK, which has been incredibly strong over the last 12 months. And we've been able to lock into a land value on Newport Pagnell that's significantly below market value now. Now, we believe that our land holding in Newport Pagnell is probably now worth double what we paid for it. So there's a significant amount of inherent land profit in that site before we even get into potential development profit that would come out of occupier deals. So that is really exciting as far as Newport Pagnell is concerned. But actually, generally to the rest of the portfolio, we have bought well. We have sites that are held at a discount to market. So with that sort of growth in land values and rental growth and the sharpening of yields, it's really put a lot of inherent profit into the land portfolio before we then even get into development portfolio. So it's just important, I think, to pause specifically on Newport Pagnell at that point. So then moving into 2022, we would then see ourselves starting on site on Junction 24, putting in the infrastructure for the spec scheme that we talked about, drawing down the land at Basingstoke as well. And then as we get into March and the spring, we're then starting to put in land acquisition at Coton Park and infrastructure, hopefully concluding the planning and the 106 agreements at Newport Pagnell. Moving into May, putting in the infrastructure for Basingstoke for the whole site, starting on site with the buildings, the speculative buildings for Junction 24 for the third-party funder. And then as we get into the main bit of summer, we would anticipate securing planning consent at Thrapston. I would be extremely disappointed if we're not announcing at that stage pre-lets as well, given the interest that we have in that site. And then we would hope as well by then we're starting to move into some of the other schemes such as A1 West, which is our land on the west side of the A1 at Peterborough. So it's on the other side of the dual carriageway from the scheme where we've just completed Amazon. And we would hope to be in for planning by the summer of next year. Putting in infrastructure at Newport Pagnell. And then as we move into the sort of the autumn and the sort of last quarter of 2022, we're then really looking at sort of Hoyland infrastructure completing, potentially the A1 West Peterborough land acquisition, the construction at Hoyland ending, and then the sort of final bits of the jigsaw for next year. Hopefully we'll be drawing down the land at Thrapston and potentially starting infrastructure at Peterborough, and then PC of Hoyland. So there's a lot of milestones there through 2022 that the team are focused on, and then beyond in 23 delivering the sort of planning permissions for the wider portfolio. So yeah, look, the team are really excited and have been working incredibly hard, and we've got a fantastic portfolio now that's really starting to come to fruition. So it's it's a very exciting time.
Fantastic.
So that Andrea, concludes the UK presentation.
Graham, thank you so much. Simon, thank you. Thank you guys for the participation. We don't have a lot of time left, so we're just going to quickly touch on our prospects. I mean, I think a lot of this has come through, but if I could just reiterate a few things. First, we do expect 3 pre-let deals in SA in the next 12 months, over and above what is currently on this list. We do believe that there are some buying opportunities that are going to come to fruition in SA in the next 12 months. We do believe, and this has put Graham and his team under pressure, that they will deliver at least 2 pre-lets in the UK in the next 12 months. And we do believe that there'll probably also be 2 turnkey developments in the UK over the next 12 months. So the prospects for Equites as an organisation in terms of what's contracted and what's potentially coming is massive. We are very excited as an organisation. As they say, you know, we must make hay while the sun shines, and it's certainly the logistics sector's moment in the sun, and we are trying our best to continue to deliver on our promise of best-in-class quality product. Just to close out, obviously where we're at in terms of the various structures, obviously the list, the offshore business, the dual listing or the sale of the minority stake, these were all a function of the work that we're currently doing, but they are a function of cost of capital, and they are a fact of availability of capital. In terms of our JV with the SA Pension Fund, we are fairly confident that we will announce something before the financial year is out in terms of that JV, and we are very pleased with the outcome of that process. We continue to evaluate our existing portfolio in the UK, and there are potential opportunities for potentially taking advantage of some of the exuberant pricing at the moment there. We continue to look to the South African capital markets, and accelerated book builds and DRIPs will remain a feature of our business as long as the cost of that capital is such that it makes sense for us to take advantage of it. And I think a really interesting addition to our business is what Graham alluded to and Simon have alluded to, is the turnkey development for speculative funders or owner-occupiers in the UK, where we basically execute, we make a land profit, we make a development profit, and we recycle that money back into our existing portfolio to the benefit of the balance sheet. So in a nutshell, I think that's where it's at. We continue to confirm our guidance of 5 to 6% for the financial year. We are obviously looking to target NAV growth per share also in the second half of the year, and expect to be able to give double-digit total return for the financial year. So I think that's us in terms of our presentation done. I'm going to hand over to Rian now. I believe he does have a couple of questions, and we'll try and answer them. I know we don't have much time, but we will try as best can. And obviously, we're very happy to engage with people offline post the presentation too.
Thank you, Andrea. Graham and your team, I think the first one's for you. It's given the current truck driver shortage in the UK, what could be the potential impact on your portfolio from a financial and operational point of view?
Sorry, could you just repeat that question, guys?
Given the current driver shortage in the UK, what could be the potential impact on your portfolio from a financial and operational perspective?
Yeah, I think, the supply and demand dynamics, there's a number of other factors that we perhaps haven't talked about that are having an impact on the UK, and that's construction price increases. we're seeing quite a lot of inflation that's now hitting construction prices. So the land value growth has been driven by partly sort of yield compression, but also by construction price inflation. So we really see a lot of rental growth potential through the UK over the next sort of 12 months. If you look at operators, historically the rents in the UK are actually still quite low. It's only in the last year or so that we started to see strong rental growth. So we still think there's a lot of headroom potential for rental growth in the UK portfolio. So I think that's probably going to be one of the most interesting supply and demand dynamics that we'll see over the next 12 months.
Fantastic. Thank you.
Thank you. The second question for Andrea from Daniel. Will you undertake any turnkey developments in South Africa?
We have indicated that we will on those specific pieces of land that we are very happy to do turnkey on. We won't do it on every piece of land. More importantly, also, apart from turnkey, on propositions of a value of greater than 200 million rand, we're also very happy to go into joint ventures with the owner-occupier, for want of a better word. So yes, in a nutshell.
Thank you, Andrea. Then one for Leila. Do you think the valuations of your SA and UK portfolios are conservative?
I mean, I think I'll start with the UK because there's just so much evidence coming out of the UK portfolio. If you look at the compression in our portfolio from last year, August, until this year, August, our portfolio values have probably compressed by about 60 basis points overall, whereas the overwhelming evidence out of the UK is that prime logistics yields have compressed by more than 75 basis points. So I think there's still room for further compression. What's also still to come are the Amazon and Hermes valuations, and those are brand new products on 15 and 20-year leases, and there we're still valuing them quite conservatively. So I think from a UK perspective, we've definitely been conservative. On the South African side, what we have seen is that we're definitely still emerging from this period of uncertainty. So our South African portfolio values all held fairly stable from Feb. There were some ups and some downs. But I think that as we emerge and we have stronger evidence that's coming out of the space, we have some more transactions, and GDP growth starts picking up, we hope. I think that those will also start to increase again. So we're definitely a little bit on the conservative side right now, and we're very comfortable with where we are.
If I may add, construction inflation will play its part in South Africa as well. So on the new builds, we see a bit of pricing pressure coming through the market as well.
Yeah.
Thank you, Leila. Andrea. I want to thank everybody that submitted questions. We unfortunately only have time for one more, and I'm going to ask Andrea if we are seeing any increase in demand for pre-lets in SA given the recent civil unrest and muted economic growth.
I think sort of I alluded to it in the presentation a little bit with some of the significant pre-lets that have been undertaken in SA in the last sort of 18 months, 2 years, from the major retailers. We foresee more of the same. We foresee that all the retailers are going to be investing heavily. And as I said, the buzzword at the moment, especially in the clothing retailing world, is omni-channel. And it's about being able to get product to the client, but the client could be anywhere in the country. So it's holding the stock in warehouses. Sizes of warehouses have definitely got bigger. And the consequence of that is, I think, going to be good for our business.
Maybe just to add, of the 4.2 billion rand of opportunities we spoke to earlier, a significant portion is from South Africa.
20 minutes, oh, okay. Okay, sorry.
We do have a bit more time.
Apologies. Okay, apologies. I thought we were running out of time. I've just been advised by the producer that we do have a little bit more time. So
the next question is, were there any renewals during the period, and if any, what sort of the reversion did you see on these deals? Maybe I'll take that one. As we alluded to, we've got 8 renewals coming up in the next 2 years. In the period under review, we had 2 renewals and we didn't see any significant reversions. On those 2, they stayed mostly flat. We've been fortunate up to now that the facilities that we do have are high quality facilities where our tenants are happy with them, and we continue to improve them and look at improvements that our tenants need to be able to extend their tenure. So thus far we're approaching the next 2 years with the new leases with an open mind, but we are confident that our portfolio is of a nature that it would withstand any request for reversions.
Yeah. I mean, there's another question just asking about, did Equites receive any non-GLA income for the period, or is it insignificant? If it's okay, I'm going to answer this one. But where we typically see other counters receiving non-GLA income, it's everything from potentially on-selling solar energy to their tenants, and there's a couple of other innovations, particularly in the retail space. But what we've decided to do is not to on-sell any of the solar. In fact, when a tenant signs a lease with us, any solar that's generated at that premises is given to them for free. We believe that it's part of our commitment to ongoing sustainability, and also as to assist the tenant in reducing their operational costs. Andrea,
I think I agree, Leila. I mean, we've used it as a carrot to attract the best quality tenants, and I think as tenants move into our buildings and live the experience of a properly designed and built facility, and secondly one which also affords material operational efficiencies and savings, is to create a relationship which I think will deliver for Equites for many years to come.
There's one further question maybe for Graham and his team. The question is, you've spoken through a lot of landholding parcels. Are you confident that you'll attract the type of tenants required that will fit in easily in the Equites portfolio over the next 12 to 18 months?
Did you get that, Graham?
Yeah, I think it was about, are we confident we'll be able to attract the sort of type of tenants that Equites are looking to retain on its balance sheet? Perhaps I'll pass it over to Simon to answer.
Yeah, I think in summary, I think the occupational demand in the UK is in a position that we've never seen before. As Graham and Andrea both touched on, the take-up of buildings is virtually is unprecedented, and most of those big requirements are coming from online retailing platforms, the third-party logistics operators, and also the kind of last mile delivery operators. So, the sectors that we're targeting, the demand is unprecedented. But we don't see that slowing down in the short, medium, or long term. So, in summary, we see the demand continuing, and therefore we see the potential for us securing those type of operators on the schemes that Graham has highlighted as likely, and that's absolutely what we're targeting.
Look, and just to add to that, we're talking to a number of multinational companies who have got vast portfolios globally, but also in the UK. And a lot of these companies now have mandates that have said that they've got to get rid of the portfolio on buildings where they don't meet sort of green sustainability targets. So they're under massive pressure, a number of these companies, to offload historic sort of old buildings and replace them with more modern, energy efficient, sustainable buildings. And with the supply and demand dynamics, it's very difficult for them just to sort of go and replace that stock. So, yeah, we are, and those sort of companies are major multinational companies that have made those statements. So we're very confident that we can sort of bring some of those multinational companies, into our portfolio and then ultimately onto Equites' balance sheet.
Thank you, Graham. The next question is, please quote the ICR for first half 22.
Okay, so our ICR is around 3.3, and where we forecast our balance sheet to go, we're forecasting around 3.5. You would understand that our portfolio has a significant development component, and that obviously reduces the ICR slightly. But in comparison, our strictest covenant is 2. So we're very comfortable with where that ICR is. And obviously, as our portfolio grows and evolves and that income-producing component becomes bigger, that ICR will improve. So that's the number, and we're very comfortable with it.
I think we've got one last question there, yeah?
Bundy is asking, what's your view of demand-supply dynamics for industrial property in general in SA, given the pipeline in the system? Do you have any concerns?
Okay, I think the demand side on the large 40,000 square meter plus facilities, I think, is going to be positive over the next 18 months, 2 years. I think the supply side will always be a challenge because a 40,000 square meter plus development will invariably require one 10-hectare site as a minimum, due to the yards and all the other ancillary requirements of these big users. And the reality of it is that, who controls service land in one track that can facilitate all of these potential opportunities? And the reality is, certainly in KZN, I can only think of one significant park that potentially could house these bigger requirements. In Cape Town at the moment, I could only think of 2, and in Joburg probably only 4 or 5. So, in the 10 to 15,000 square meter, obviously there's ample land to meet those requirements. But once you start breaking the 40,000 and going to some of the bigger global players and bigger retailers, then I think the stakes are much more constrained and will allow for, I suppose, better negotiations, should we say.
Thank you.
Awesome. Okay, well, everybody, thank you so much for having joined us today. We obviously will engage with our primary shareholders in the next couple of days with a view if there are any further questions that need to be asked. But notwithstanding us not contacting you or contacting you, if there are any questions that you would like to refer to the management team, please feel free to email us or give us a call, and we're always available and happy to engage to the best of our ability. But and in conclusion, firstly, I would like to obviously thank our board for what they've afforded us in the last 12-18 months. We've also gone through some natural change and introduced some new parties to our board, and we're very excited with the additions, but equally also very grateful to the gentleman that did step down earlier in the year. Over and above that, obviously my primary massive thank you and total respect goes to my co-executives who have done unbelievable work in the last period, or in the last 12 months. I think we were really challenged by the COVID situation, and I think how we've responded as a team, how they've responded with their teams, and the leadership that they've shown has really made my job probably extremely, I hate to say it, but a hell of a lot easier than it could have been. Obviously extremely proud of everybody in the organisation, and a thank you to the whole team. I'm not going to mention names because last time I completely made a matzah pudding of it, so I won't do it this time. But again, thank you to the whole Equites team, but in particular to my 2 co-executives. Cheers. Bye-bye.
Thank you.
Okay, is that okay? Yeah, cool. Yeah, okay, cheers. Bye.